There are only three ways effectively to invest your resources. There's active management, there's asset class management, or index management. So let's discuss those three different ways to invest your hard-earned money and look at the pros and cons of each. So in active management, you believe essentially that the market is getting it wrong, and you actively attempt to beat the market through either security selection or market timing. So you attempt to identify and own the most promising securities as defined before other people do. There are at least several hundred methods of active management. And if you're looking at fundamentals, you can talk about high quality, low quality, valuation differences, growth, value. You can look at management. And then there's technical analysis, such as charting, trend following, and the like. And you can do this at either the individual security level or the sector level or at the market level. Active management generates higher fees. That is, it takes time and talent to research and track the qualities that you desire for your portfolio and to implement that. If you're hiring someone else to do that for you, then you have to pay them to spend that time and effort and energy to manage the portfolio. Trading costs are higher because there tends to be more turnover in the portfolio, and similarly, taxes tend to be higher because of that same portfolio turnover. So the promise of active management is that net returns will beat indexes after these additional costs. An alternative to active management is what we call asset class management, and that is grounded in the efficiency of capital markets. Asset class management believes that the market generally works, and it works well. It believes that the market adequately discounts information into the prices of the securities at the moment. Asset class management seeks to capture specific dimensions of risk identified by academic research. Asset class management minimizes transaction costs and enhances returns through trading and engineering. Thirdly, index management uses commercial benchmarks to define your investment strategy. So the Standard & Poor's company creates an S&P 500, or the Russell company creates a Russell 1000 index, and you can invest in those indexes as your portfolio management strategy. Or you can buy sector funds. iShares has a lot of different types of funds that replicate the S&P 500 or the Russell 1000 or any of your sector funds or subsector funds. But as such, index management accepts index-like returns. You're willing to incur transaction costs and turnover in favor of low tracking error. When the S&P 500 reconstitutes their 500 stocks, the index will reconstitute its index, and therefore there will be a little bit of turnover in the portfolio at that time.